Good afternoon. Welcome everyone to the James Cooper Preston webinar on the 2016 Autumn Statement. My name is Sharon Bedford and I'm a business tax partner here at James Cooper Preston. And I'm joined today on this webinar by my colleague Ian Miles, who's a private client partner. The way we're going to run this is, first of all, I will talk through some of the changes that were announced yesterday that affect businesses, and then Ian will talk about more individual matters. Just as an aside before we start, you do have the ability to ask questions, any questions that you like, during this webinar, and you can do that just by typing those questions into the box on your screen. What we'd like to do, if that's okay, is to deal with all the questions at the end of both of our talks. So to kick things off then, as I said, I want to talk about the Autumn Statement and how that affects businesses. And really here there's three themes that came out yesterday. Firstly, the priority that's going to be given to investing in high value infrastructure and innovation, which hopefully will support businesses across the UK. Secondly, just to focus a little bit on the business tax roadmap, because one of the things the Chancellor did yesterday was actually recommit to the roadmap that had been put in place already by George Osborne. And then thirdly, just to have a look at some of the inevitable tinkering that always goes on whenever the Chancellor seems to stand up and make a statement. Firstly then, just have a little look at what was announced on the government's investment plans on both on high value infrastructure and on innovation. And what we seem to have is a new fund which is called the National Productivity Investment Fund, or NIPIF, or whatever you want to call it. However, I did wonder yesterday when I was putting these slides together whether actually it didn't really matter what this was going to be called, because actually it would become known as the Brexit Fund, and actually I saw in this morning's press that that had actually happened. But what this is announcements of 23 billion which the government is going to be spending between 2017 and 18 and 2021-22, and really as their response to making some investments, perhaps to make the country a little bit stronger as we move towards Brexit. But is it a new 23 billion, or is it actually just bringing forward some expenditure that we knew was already there? And actually, if you looked at the detail yesterday, there was a little bit of haziness in that, and I think actually it's probably a mix of the two. Nevertheless, it's a very welcome boost to the economy that the investment is going to be made, and there's no doubt lots of people who are working in businesses who will either directly or indirectly benefit from this government spending. There's a pie chart there on the slide which shows the four areas that are going to be targeted: transport, housing, digital communications and R&D, and also a split roughly into how that's going to be allocated between those. As you will see, nearly half of it is going to go into housing. I'd like to talk about a couple of those just in a little bit more detail. Part of the expenditure on the transport and the infrastructure surrounding that is actually, it was announced yesterday, is going to be directed to the Oxford, Milton Keynes, Cambridge corridor, which obviously as we operate largely in the Thames Valley is a particular interest. This was a recommendation of the new National Infrastructure Commission, which is a body that's recently been set up to advise the government on where it should be directing its investment into infrastructure. And this is quite an interesting example because we show there the amounts that have been directed towards this. So £27 million going towards helping to build the road between Oxford and Cambridge. 100 million brought forward to accelerate the construction of the rail link, and some money on railway stations. but you'll see there the words brought forward. So a little back to what I was saying a minute ago, is this a new fund or isn't, is this new money or old money? Well, the jury's out on that one. But the whole idea of this is to create a new tech corridor to link the two big universities. Well, I think the Chancellor said the two leading universities. I suspect there's other universities that would quibble with that. But anyway, to create a new tech corridor. Probably very welcome for businesses in this region. Also important for the local economy is announcements of more government money available to support R&D. I think this was partly pre-announced by Theresa May in response to a lot of the concerns that people were raising as to what would happen to funding of our high-tech businesses and universities once we exited the EU. And there was some good news there. So there's going to be an Industrial Strategy Challenge Fund, which will help collaborations between businesses and the UK's science base, and that's going to be managed by Innovate UK and the research councils. It had also already been announced that there was going to be another 100 million available to the biomedical catalyst. That was reconfirmed yesterday. And a new initiative, and that £100 million is going to be put aside to incentivise university collaboration in tech transfers, so potentially more spin-out companies on the horizon. On the tax side, there was also a promise to look at future enhancements to R&D tax credits, although we don't really have any detail on this. This implied that it was actually for the larger companies rather than SMEs, but we will watch that space and you know, be able to update people as that detail comes out. So you'll recall I was saying there was three themes that I wanted to talk about. The second of those was the business tax roadmap, and as I said, what Philip Hammond did yesterday was basically reconfirm that he, at the moment at least, he was driving along the same road that George Osborne was planning to do. And there's two main themes to the business tax roadmap. One is reducing the burden of business rates on businesses, and secondly, making sure that we have a competitive corporation tax rate and regime. There were some good news, further good news yesterday on business rates, especially for rural businesses, and that no doubt was very welcome. But moving on to corporation tax, you can see there from the top bullet points on the slide that corporation tax rates are coming down, and I think it's quite easy to forget that it wasn't that long ago that we were dealing with corporation tax rates at 28%. So these falls are you know, very, very welcome, and as far as they go at the moment, no change from what was pre-announced. So currently at 20%, going down to 19% from next April, and then commitment which is already enacted for 17% from April 2020. I think though, however, we are watching the space on this one. One of the comments that George Osborne, I'm back with the old Chancellor there. One of the comments that Philip Hammond made yesterday was that Britain needs to be open for business. And I guess sooner or later, and possibly before 2020, the question will be asked, is 17% the right rate to, you know, in a post-Brexit world for the UK? The second sort of unknown that we need to sort of factor into thinking on corporation tax rate is what President-elect Donald Trump will do. As part of his election campaign, he said that he thought he would bring down corporation tax rates in the US to 15%. Given that they're well into the 30s at the moment, that would be a radical change. And I think it'll be something that if it happens, all other developed countries, the UK included, will have to have a think about and see how they're going to react to. You might remember on Monday this week that Theresa May actually told the CBI that she was committed to having the lowest rate in the G20. Whether that actually factored in very low US rates, I think there is more speculation about. But anyway, it's a little bit watch this space. But the good news so far is that we're not deviating from what George Osborne had previously announced. There was a little bit of talk yesterday about large companies and multinationals. Just as a little bit of background, the UK has been a real leader in looking at the international tax horizons and actually trying to work out whether the tax system is fair, or whether multinationals like Google and Starbucks and all the other high-profile companies that have been in the press can actually avoid international tax rules to actually not pay very much tax at all, or not pay probably their due share. And the BEPS project has been the outcome of that. Quite a lot of clients have asked me, will Brexit affect BEPS? It may do around the margins, but I think the UK are very committed to that project. It's an OECD-led project, not an EU-led project, and so I think it's very much still going to be on the cards. Whilst that's really directed at larger companies, though, it does have a lot of impact on smaller companies, and therefore as that develops, all companies have to keep an eye on what's happening there and the fact that it might ultimately affect the amount of tax that they pay. A couple of changes related to that are coming in there, both from April 2017. Again, these have been pre-announced, but have been subject to consultation, and yesterday Philip Hammond announced that they were still going to go forward. The first of those is on losses. There is going to be a lot more flexibility how companies can use their losses brought forward from earlier period, but that flexibility does come with a cost. And if you have taxable profits over 5 million, it is going to be going forward the case that quite often you won't be able to fully offset all your profits by losses brought forward. So some companies who previously thought they didn't have to pay tax might well be in that regime. As far as interest deductions are concerned, some changes there as well, but this is only for companies who have a net interest expense of more than 2 million. But if you are in that bracket, then your interest is only going to be restricted to 30% of your UK earnings when you're calculating tax. Moving on then to the inevitable tinkering that comes with every budget or autumn statement. As has become the case, there was a lot of changes that were brought in to look at anti-avoidance. It really is now becoming the norm that anybody that's doing any tax planning that doesn't necessarily work with what Parliament's intended tends to get shut down quite quickly. And there's a list there of some of the ones that were announced yesterday. Employee shareholder status was some legislation that was actually brought in originally, which allowed companies to give shares to their employees in exchange for them giving up some of their employment rights. It has really become something that was only typically used by top managers and directors, which wasn't its original intention. So that's now been abolished. Moving on a little bit more to tax planning schemes, there's been a lot in the last few years that have been looking at planning options where employers have tried to give employees remuneration without them necessarily paying tax on it. A lot of those have now been clamped down. The Chancellor obviously thinks that there are some more around, particularly in the area of the self-employed, and so if you are a self-employed person looking at some sort of complicated planning, beware, because HMRC are closely behind you. IR35 companies, this is a bit of an old chestnut really. This is where people just incorporate they're just basically a one-man company, but they incorporate to get a better tax rate. This is something HMRC have been trying to tackle for 10 plus years without an awful lot of success. Apparently they're going to have another look at that, depending how it'll be interesting to see if they can be a bit more successful last time. Changes to the VAT flat rate scheme. It's become possibly common that businesses that have limited costs have been getting a slightly more favourable VAT treatment than was envisaged by this scheme, so by the flat rate scheme, so that's been closed down. One that's not quite so good for us, penalties for promoters of tax scheme. James Cooper Creston don't do this, but there are some people out there who promote tax planning that isn't necessarily what HMRC would like. There actually are going to be penalties going forward for people that do that. I think the fear from the profession on that is, will it also catch the innocent? So there's a lot of focus on that and what might happen on that as the legislation evolves over the next couple of months. And there is going to be more investment in HMRC accountancy avoidance teams to make sure they have the manpower to follow some of this through. A couple of things on duties. Fuel duty has been frozen. I'm sure that's very welcome. Unfortunately, however, for the motorists, it's not all good news because the insurance premium tax is going to rise from 10% to 12%, and obviously that will affect motor policies. Just before I finish, just on a final note, you may be aware that there's a lot of talk at the moment about making tax digital. This is going to involve a lot of businesses doing a lot of their tax returns, etc., through government portals, but it's also perhaps more importantly going to mean that many businesses will actually have to file quarterly tax information rather than annual tax information. There's been a lot of debate on this and how it will work, and we know from what was said yesterday that in January 2017 we're going to get a lot more detail on that, so something to watch out for. Anyway, that's all I want to say at the moment on business tax, so I'm going to pass you over now to Ian, who will talk about some of the more measures in the autumn statement that affect individuals.
Good afternoon everyone, and welcome to my part of the webinar. Like business tax, much of which was stated yesterday is really a reiteration of what had been announced before. In many ways it seemed to me as though it was as if a new government had come into play and really felt they had to restate what the previous regime had said just for the sake of confirmation. So if we start to look on at some of the stuff that I've got to talk about, the personal allowance for next year is confirmed at 11,500, and Philip Hammond said that the government is still committed to having a personal allowance of 12,500 by the end of the Parliament, but that once it's reached that, it will then rise in line with the consumer prices index and not at, as does the higher rate threshold, and not in line with the national minimum wage. National insurance threshold is going to be aligned from April 17, so that both employers and employees will start to pay national insurance on weekly earnings once they get to £157, and that's supposed to simplify life for employers. A couple of new bits then that we're in. First on salary sacrifice schemes, and the following consultation, the tax and employer national insurance advantages of salary sacrifice schemes will be removed from April 17, except for arrangements relating to pensions, childcare, cycle to work and ultra-low emission cars. And that will mean that employees who swap their salary for benefits will pay the same tax as the vast majority of individuals who buy them out of their post-tax income. Arrangements in place before April 17 will be protected until April 18, and arrangements for cars, accommodation and school fees are protected until April 21. Following on I think on a similar theme, the The valuation of benefits in kind is also going to be looked at, just in terms of how they're valued for tax purposes. And that's going to be, I think, in next year's budget. So the headline things in salary sacrifice schemes: is this the end to cheap gym memberships provided by employers, home computers, parking, that sort of thing? If we look at the valuation of benefits in kind, we don't have any more information than that which was published yesterday, but maybe it will include things like looking at the valuation of healthcare benefits and that sort of thing. And then finally, on that particular theme, the government is going to publish a call for evidence at next year's budget on the use of income tax relief for employees' business expenses, including those that are not reimbursed by their employer. So where the employee says, I've got an expense which was wholly and exclusively for the purpose of my employment, I'm deducting it from my income. So what that exactly means we don't know. We'll have to wait until next year's budget. Something else that was previously announced was in the budget this year was that there's going to be 2 allowances of £1,000 each for trading and property income. And the interesting thing there, I think, was it was trying to catch a black economy. That's my view. So the eBay traders, what it's saying is if you've got income of £1,000 or less, don't worry about it. But actually, if everybody's got income of more than £1,000, whilst you should have been reporting it before, we'll probably know who you are from trading records. So put it on your tax return and change your behaviour to disclose it, please, before we have to come looking for you. That's what my guess is about that. But they've confirmed yesterday that that's still going to be in place. One thing that I was a little bit surprised to see given space in the literature yesterday was the consultation on non-UK domiciled individuals, because we've had quite a lot of this that's been previously announced, and it's probably worth just spending a couple of minutes looking at that. This has been a consultation that's been rumbling on for some time. We've now got draft rules that are out. Domicile is really where you belong as an individual. So companies don't have domiciles, but individuals do. It's really where is your home of homes, not just where you happen to be living at the time. And so the rules are that if you have lived in the UK and been tax resident in the UK for 17 out of the last 20 years or more, then you will be caught as UK domiciled for inheritance tax purposes, but not for income tax and capital gains tax. And at the moment you can pay the remittance basis charge, which means that you're only taxed on your UK arising income and not on your worldwide income unless you choose to remit it into the UK. And so you can pay for the privilege for doing so once you get beyond being UK resident for 7 years. Now, what the government has previously said, and it started in the Osborne era, was that they wanted to ensure that non-UK domiciles paid a fair share of tax. So the rules are changing so that from next April, if you've been resident in the UK for 15 out of the last 20 years, then you're UK domiciled for all tax purposes. And if you have a UK domicile of origin, so you were born here, your parents were here, you're a Brit, and you happen to leave and say, I'm never coming back, and then you subsequently come back, you'll be caught as being UK domiciled from the time you set foot back in the UK. So there are rules for people who've arrived in the UK, either never having come here before, or those who've been here, left and come back. As part of that, quite a lot of non-UK domiciles currently live in residential property that is owned through an offshore structure, typically a trust which owns a company, and the company owns property that is in the UK. And using various measures like that, it's quite possible and legal currently to escape inheritance tax on the value of the UK residential property. Well, all of that is going to change from April next year, when IHT will be charged on residential property even when it's held indirectly through an offshore structure. However, what the Chancellor also recognises is that he wants to get inbound investment into the UK from non-UK domiciles. So he's going to make it easier for non-UK domiciles to bring cash into the UK when it's for investing in UK businesses. And there's going to be, I think, further developments on that front to attract offshore capital investment into the UK. From what we've seen so far, there are possible planning opportunities around what we call the cleansing of capital. So if somebody has what is known as a mixed fund that has some clean capital and some capital gain or profits in it, or even some income on that lot, it's going to be possible to clean up the capital so that you can remit the clean capital and leave the profits, the gains and income offshore and not remit those without triggering a tax charge. And in addition, it looks as though rebasing for capital gains tax purposes will be possible. So clearly the Chancellor is trying to make it easier for people to bring cash into the UK to invest in UK businesses. But he's also trying to catch those people who have been UK born and bred, gone offshore, waited a sensible time and then decided they will come back, so that they don't have their cake and eat it. Just still on the inheritance tax theme, a new relief appears to be where donations to political parties are being extended, where you've got representatives in the devolved assemblies, and also to parties who acquire representatives, I guess MPs or whatever, through by elections. So moving on to pensions and savings, the increase in the ISA limit next April to £20,000 was confirmed. The starting rate band for savings is remaining at £5,000, and whereas we've done quite a lot of planning in the past with husbands and wives to make sure that if one spouse was a higher or additional rate taxpayer and the other wasn't, that they had all the investment income and savings income. Now we're trying to rearrange things so that both spouses make use of their 5,000 starting rate band. One thing that was announced yesterday was a new savings bond through NS&I, a theme that came through from yesterday's autumn statement was that the recovery and debt repayment is going to take longer and is going to go into the next Parliament, and the Chancellor is going to fund that through borrowing. I'm not sure that whether you'll get enough through the new savings bond, because you can only deposit up to £3,000 a year in it on an individual basis, and the interest rate is going to be 2.2% gross. He didn't say whether the interest would be taxable. Most NS&I interest isn't, but he did say the rate would be 2.2% gross. So that might compare quite favourably with an ISA under current rates, if that really is gross interest. And there will be some people for whom the NS&I bond is attractive. Some may choose to put some into that and some into their ISA or whatever. One thing that I thought was new yesterday was that the money purchase allowance is being reduced to £4,000. So if you are drawing down on a pension, then the maximum amount that can be contributed to your pension is reduced to £4,000. So if somebody had retired, was drawing their pension and then got another job, then the maximum that can be contributed to their pension scheme is £4,000. And then the final bullet point on that slide is foreign pensions and lump sums to be brought into tax in the UK for UK tax residents. Haven't got much more detail on that, but I would guess that if the foreign pension is taxed in the foreign country, then there will be a tax credit for the tax that's paid over there against tax liabilities here. Well, that brings me on to my last slide, a roundup of what wasn't there. Fundamentally, no changes to capital gains tax. We always reckon that capital gains tax gets revised about once every 10 years. Big changes in 98, 2008, so 2018 might be a good time, but it certainly isn't going to be in 2016. No changes to inheritance tax either. So the nil rate band remains unchanged, and really valuable reliefs such as business property relief and agricultural property relief are unchanged and importantly uncapped. So you could have an unlimited amount of property that qualifies for business property or agricultural property reliefs, and there is no limit on the relief you can get. And there's been much speculation over the previous few months that this valuable relief would be capped. Well, it certainly wasn't capped in the autumn statement. And fundamentally, no change to the basis of income tax either. So all really fairly quiet on the personal tax front, bar the changes that I've already mentioned. And that brings me to the end of my part of the presentation. Thank you.
Thanks, Ian. We haven't had many questions through, but we have had one, which I'll just sort of recap on. Question on, I mentioned the employee shareholder status, a question on whether that had any knock-on effects on EMI share option plans, other stock options, and the answer to that is no. So very much if you're thinking of using any of those other possible range of incentives to help your employees get shares in their company, then that's very much still game on, and obviously we would be delighted to talk to you about and to help you to be able to do that. So as far as no more questions then, so unless what we were going to do then is call this webinar to a close. I'd like to say thank you very much for attending. You'll see on that last slide there are the details of both Ian and myself, and obviously some of you might have other contacts in James Cooper Creston and we would all be delighted to answer any questions individually you might have on this talk or on any other topic. Thank you very much.